Yo, what's up? It's your favorite disembodied voice of a small business CEO coming to you on the topic of search funds, specifically asking the question of if a search fund is worth investing in. This would be whether you're a family office or someone considering investing in someone who's approached you with a search fund opportunity, or if you are a entrepreneur considering raising a search fund, whether it's worth the time investment. And I'm going to be pulling data from the 2024 Stanford Search Fund Study. So let's get into it. So search funds are getting popular. They're in a lot of books lately. Harvard Business Review's got one. There are a couple others. So yeah, as they become a hot topic, I was doing some research into them myself and found there was a lot of soundbite quoting about the IRR of the asset class and stuff, but there was some analysis that I thought would be reasonable to do on an investment opportunity that I had not seen anyone doing on search funds. So that's the inspiration of this video. But yeah, they're on the rise, so it's more likely that you'll encounter this sort of thing. And yes, the big news for search funds is their IRR, which is 35% all time in this Stanford study. And then recently it has been as high as 42.9%. So pretty impressive IRR, but you know, what does that mean? And what's the difference between IRR and CAGR and things like that? So that's what we'll get into here. And this is the sort of data that we will work up to, pull in from this Stanford study. But I just wanted to put this here because I feel like the 42.9% IRR sounds amazing. 35% IRR sounds amazing. But when we look at the actual outcome spread, it's still cool, but less flattering. And we'll unpack how IRR as a measure of success conceals kind of some of the more less flattering aspects of this type of investment. So yeah, let's look at the risk reward analysis like what I just showed you, and then ask the question if it's good for a searcher or if it's good for a capital investor, and then ask how it could be improved, or what circumstances might push something like this above the average outcome. Let's look at it. So the best page in this Stanford search fund study is this page on the ROI outcomes. Overall, some of the graphs I feel in this study are less useful to an investor considering, a serious investment. But this graph, I think, really gives a lot of good information. So what I did was pulled out all the data for businesses that are still operating. If you look at this, half the data is for businesses that haven't been exited. I only want to look at businesses that have completed an exit. And then from there, I'm going to try to rebuild my way to the IRR statistic Stanford shares. And I'm doing it this way because as far as I know, their data set is not public. So this is the way I could figure out how to reverse engineer the risk reward profile. And this is what we get. 37% not purchasing a company, 8-something% as total loss, 8-something% as partial loss. I will say for the total loss, partial loss, elsewhere in the study, I crunched some other numbers using other graphs. And based on those other graphs, the total loss and partial loss together were supposed to add up to 15.5%. But then here they're adding up to something like, I guess, 17%. I'm just working with the numbers that are in the Stanford report, and there's probably some rounding going on. So I'll just say, plus or minus 2% on this stuff. And then we've got some upside cases, which also same deal, plus or minus 2%. About 5% for 1 to 2x, about 19% to 2 to 5x, about 16.5% for 5 to 10x, and then 5% for 10x plus. All right, cool. Yes, so my first thought as I computed this was, well, this distribution of outcomes isn't what I don't know what I expected when I heard that it was 35% IRR, but this distribution of outcomes felt wider than what I expected. There was more downside than what I expected. I kind of thought there would be a normal shaped curve around 5x ROI, but there was more on the downside of 5x than there was on the upside. And I was also surprised that over a third of people made no purchase at all. Maybe it's just my personality type, but I feel like I'd want to go ahead and buy a business and get in there and create value. But, those people who did make a purchase, maybe that's wise. It seems like a lot of the opportunities didn't turn out to be great investments for a certain percentage of these folks. And if these are folks that went to Stanford Business School, they're probably pretty smart and capable people. So no purchase might have actually saved the investors money if all the opportunities they came across were bad opportunities. But it's just something that I didn't expect when I read the executive summary at the top of the report. All right, and let's do a common sense check on this distribution of outcomes. So I know this is like a 30-second financial model, but these search funds buy companies worth $16 million at, I think this is an SBA loan type of leverage I did, so 20% down. In real life, it's a lot more complicated than that, but just napkin math, that kind of leverage buyout with a 5-year hold period does get 5x ROI. So it makes sense to me that our outcomes would be centered around that point. This model also, I threw down 20% as the growth rate for the resale price of the business. A lot of the books about search funds encourage people to target recurring revenue service businesses that are growing at a rate of 15 to 20% in sales. So I just kind of took that as the thesis and ran with it. I don't know if that's the thesis that most people actually do once they get into a search fund, but that's the thesis that seems to be advocated for in popular literature. And for the downside case, corporate default rates chill around 7%-ish. So seeing a total loss rate of 8% isn't a total shock for people using leverage to buy a company. And then there have been some other studies that suggest in private equity, bankruptcies could be as high as 20%. That seems like it would be very high. I haven't studied, the data of private equity outcomes, so I don't really know in detail, but our finding of 8% for a total loss, or if we pulled out no purchase, I think it'd go up to about 11%. All that seems kind of within the realm of reason. So yeah, my finding from that is distribution seems right, and then asking the question of how do they get to 40% IRR with a distribution that has so many people not purchasing a company and a reasonable amount of people having a total loss. Well, to do an IRR calculation, I needed to guess some average ROIs. So I pulled hold time data from that Stanford chart. Let me mouse back to it real quick. It has the hold period, average hold period listed. I don't know if it's average or median, but something like that. So that's what I plugged in there. And then I just flat out guessed for ROI. I put 0 for the ROI of no purchase and the whole time as a number very close to 0 because it messed up some formulas if I did it a different way. Really, no purchase is a weird one because you never buy a company. So all you did was, spend 2 years burning through 500,000 in searching money. And by IRR standards, you could argue the project never began, or you could argue that the project was just the search, but then that search project would be much smaller magnitude than the project of buying a business for millions of dollars. So anyway, that was just a compromise I made in my charts so everything would compute. Total loss, I put ROI 0. Partial loss, I didn't know what to put for partial loss, so I just put 0.5. 1 to 2x ROI. Since they're holding for almost 6 years, I put 1.8, hoping that, it's on the favorable side of that outcome spread. 2 to 5x and 5 to 10x. The hold time for these two categories is almost the same, and my napkin math tells me that 5x ROI is the expected outcome of this investment thesis. So I figured the 2 to 5 category was closer to 5, so I picked 4, and figured the 5 to 10 category was closer to 5, so pick 6. And that left me with what I'll call the unicorn outcome, which has a long average hold time. And these are just companies that kept growing. So for this, I actually just did a guess and check and found an average ROI that got things to compute close to Stanford's number, and everything else looked about right. So that was a guess and check number for 33. Yes, so maybe the core of this idea that I had going into looking at all these numbers is that IRR is not, an investor's best friend when they're trying to compare different types of investments. Private equity funds use IRR to make claims about, the quality of their returns, but, there's the S&P isn't looked at with IRR. Bonds aren't looked at with IRR typically, so take it with a grain of salt. Here's the formula I got off Google for IRR, which works because we only have one investment and our formula is pretty simple. Funds that have multiple investments can get a bit complicated with how they compute IRR, and there's a whole even academic rabbit hole about that if you want to spend a lot of time on Google. I'd say the highlights that I looked at for search funds are IRR ignores the opportunity cost of capital that hasn't been called yet. So if you tell an investor, in 18 months, I'm going to ask you to spend, whatever it is, $1 million to invest in a business or something. That $1 million has to sit fairly liquid somewhere waiting for the day that the searcher calls for it. And no IRR formula is built to measure the opportunity cost of having that money not be in some other type of investment. IRR lessens the impact of no acquisition because it's about the size of the money you put in and the size of the money you take out. So you'll see that. And then IRR emphasizes the long hold unicorn outcomes for the same reason that it lessens the impact of no acquisition. So this is something that a lot of time could be spent on, but it's just the 1 minute version is, IRR versus compound annual growth rate might give some surprising results. So yeah, let's compute compound annual growth rate. What I did for this was I added on 18 months to all the time windows because I read that it takes an average of 18 months between when the searcher secures investment to when they actually buy the company. And I didn't assign any, growth rate to that money in those 18 months. Theoretically, someone with great treasury management skills could be getting money on that uncalled capital. But just for simplicity, I didn't worry about that. For no purchase, I've basically got them losing $500K on about $4 million, assuming that the investor held the capital to make the larger investment, and then it was never called. So the loss was only the $500K. So that's how that one computes out. And then the rest look about like the IRR, but just plus that 18-month period. So that's how the compound annual growth rate chugs out. And then for IRR, it's this formula. So future value over present value is basically my average ROI. And then number of periods is the whole time. And these are the outputs there, which these upside cases start to look like the Stanford results. Okay, so how does Stanford get to its overall claim that the asset class, so to speak, has an IRR of 30-something% when there's all these negative downside cases that account for something over 50% of the outcomes. Okay, so I believe that they compute their internal rate of return by looking at all of the search funds in their database as if they're one giant private equity fund, and not counting, capital is coming in until it's called. So I took the weighted average of all the ROIs, weighted average of all the hold times, plugged it into my IRR formula, and got their what they say the IRR of search funds are. So yeah, and then the caveat would be that's if you look at all of them together under that particular formula. On the other hand, if you want to look at the compound annual growth rate and do a weighted average of it with the likelihood that each of those things is going to happen, if you include no purchase, the weighted average was 0. And if you exclude no purchase and just go for outcomes that had a business purchase, the compound annual growth rate I computed was only 4%, which is less than the S&P 500. So, yeah, the compound annual growth rate varies a lot from the story that the IRR is telling, and a lot of it is that you've got a negative 100% outcome that if you pull out no purchase, like maybe, I don't know what that it would be, 11 or 12% are going to 0. So that stings a lot. All right, so here's, the outcome table, and I hope you can use this for your own decision making. But let me give you some takeaways that I've found when I try to put myself in the shoes of these different people considering this as an investment opportunity. As a potential searcher, would I sign up for this? Personally, probably not, because so many of the outcomes are negative. And in the case of a total loss, which about 8% of people seem to be having, if I got an SBA loan to finance this purchase, then I would have to put a personal guarantee on that loan. And if I was one of the 8% that had a total loss, then, I'd probably be going personally bankrupt trying to pay back that loan, potentially. So I know that all businesses have a chance of failing, but failing with leverage and being personally on the hook as a individual who doesn't have a high net worth, that would be a stinky situation, in my opinion. Okay, another drawback is When the outcome is positive, equity gets locked up in a rollover. So theoretically, the founder, CEO person is supposed to pull somewhere between 20 to 30% of the equity out of the final sale as like a performance bonus. But what I've read happens in practice is, a private equity fund comes in and buys this business usually. And then private equity wants you to roll over about 20 or 30% of your equity into their new deal, like whatever it is, a roll-up entity or something, so that you still have skin in the game and stay on as CEO or whatever. Well, a lot of these people live out the same narrative of that you hear all the private equity people live out, where, they stay on as CEO for 1 year and then get canned, and then maybe the deal doesn't work out to what everyone hoped it would, and 5 or 10 years later they get their money and it's not what they wanted. Well, when all you get is the 20 to 30%, almost all your money from doing a search fund beyond your salary is locked into that new private equity vehicle. So I'm sure those things go right, but anecdotally from people I've met, I hear the horror stories, and, a lot of the literature promises, at the end of this, you'll have $2 or $3 million. Well, not liquid. The other investors will probably force you to be the one to put it into the rollover. Another is career moves. So this Yale professor and a student or somebody interviewed people who did search funds and asked how their life went. Most of the people they interviewed had a substantial upside outcome. So like I'd say 70 or 80% of the people interviewed had some kind of upside, but we know from our own probability distribution that that's not the distribution of what actually happens. No one they interviewed made no purchase. One person I think had a partial loss, and the others had IRRs in like 30 or 40% zones. And I think 2 people were unicorn outcomes. And even they were complaining about, having their equity locked up, or struggling to find a next job or something. So part of it's probably because this type of project has been so rare, that it's not like there's a career pipeline. But, if it's something you do, some of these people did it less than 5 years. They sold early, or ahead of the median or mean or whatever. So, you don't want that to be a dead end for your career. These people are still young and have a lot to offer. So that seemed like a negative. Yes. So could the searcher's experience be de-risked in terms of the bankruptcy risk and career impact? So those things would make it seem more attractive. Should an investor sign up for this? So maybe I'm not doing the math right, but I believe the weighted average compound annual growth rate is 4%. So that's not even as good as the S&P 500. Personally, I'm surprised to see the math work out that unfriendly. But it is what it is. I don't know if it's because these search funds are usually by people who are first-time CEOs going into an industry where they have no prior experience, or if it has to do with leverage or the thesis not being strong enough or taking advantage of multiple expansion enough. I'm not sure, but if that is the actual weighted average compound annual growth rate, and if over a third of people weren't even going to invest my capital after sitting on it for 18 months, I would be pessimistic about this type of investment. Although in my heart, I want to love it because the ideologies and things it's associated with small business always seem great, but the numbers don't look good to me today. How could all this be improved? So I believe a stronger thesis. a lot of the search fund books are basically saying buy a business that already has nothing wrong with it and then just sit on it for 5 years and don't do anything to it and then sell it. And they're saying, oh, founder entrepreneurs would love to sell you their business because you're not going to change it. And their biggest anxiety is that you'll change it. Well, who do you think these searchers sell their business to? They're going to sell it to private equity. I mean, like, we can't live in this bubble that if something's wrong with the business or someone's nepo hired, that they're never going to be fired. That's a delusion. So, if someone's selling their business, they have to see it as an asset. And why would they sell it to you if it's really perfect and nothing's wrong with it? And that thesis really was going to work out. So it just seems rare and not like the strongest thesis. Also, it doesn't take advantage of multiple expansion. Like some of the unicorn upsides explored in this article did inorganic growth through buying another company to expand their portfolio. So things like that can get you real value creation. And, bringing in more strategies like that could make it a more attractive type of investment. Having a mission and vision for the company. So I think maybe it's just because my CEO mind, but like a lot of investors in these types of businesses who are purely financially motivated, buying a relatively small business, I just wonder, like, of course the crash rate of these companies is so high is because, value creation is an afterthought, when to me it seems like that should be like the main thing, is like understanding the industry, understanding the business, and really connecting with the customers and the employees. Like, that seems like that should be so key to success. And of course, I got to put something in about culture, because when the culture goes to crap or isn't developed or whatever, that's not great. And I guess culture is saved by the search fund thesis, the idea that, oh, we're not going to mess anything up, we're not going to touch anything. But it's not strong. Just saying like, I'm not going to make it worse is not the same as, coming in with a new positive vision was a strong direction. Yeah, lessening personal guarantee default risk for the CEOs. Having all that personal guarantee risk, stepping into a stranger's business is scary. If it would be a size of a business that my personal net worth couldn't cover. Mitigating total loss risk. Yep. So let me see if I calculated it. No, I didn't. But if we pull out total loss, weighted average CAGR would bump up to like 20% or something like that. So of course, it's true of all statistics, distributions, or whatever. But if you have a situation where you lose all your money, like, it's hard to keep going back to the gambling table when you don't have any money. So that's always going to hurt your CAGR, and any way to reduce the risk would help there. But I'm not sure if that's realistic to reduce the risk, looking at the bankruptcy statistics from private equity and corporate default rates and stuff. That might be something that can't actually be improved. I'd say stop using IRR. This is a great example of how the internal rate of return tells a different story than the compound annual growth rate. I'm sure a lot of these search funds are still great investments, but, if we want to look at it kind of just by numbers, the internal rate of return, sparks an interest that isn't sustained by a deeper analysis. And then developing employment pipelines for exited searchers of all outcomes. Yes, because there's a spread of outcomes. Yeah, I could imagine people who did this and had some success. Why wouldn't private equity firms recruit them to be CEOs for portfolio companies? People who made no purchase, maybe I'm just biased against that outcome because it goes against my personality, but if they've done deal sourcing and really made a legitimate effort, I could imagine them doing those same type of things at another firm. And people who had partial loss or total loss, of course, that's really going to sting. But if they communicated well with their investors, the actual percent outcome of an investment I read recently is only the number 3 factor in a investor's choice to go with a fund. So it's the third factor. And the number 1 factor is communication and transparency in the investor relations. So if the person's been transparent the whole time, they might have something there. But, of course, if they were lying and being dishonest and then crash the company, that might be a career ender for them, for anyone. So anyways, those are my thoughts on search funds and looking at what's the actual risk reward. Is it a good investment for searchers? Is it a good investment for people with capital? And how could the outcomes possibly be improved in the future? So thanks for watching. I hope you found this video interesting. See ya.